This is really bad financial advice. Investing shouldn't be exciting. If it is, I guarantee you're losing money, and you are. They want you to idolize them like they're some trophy on a shelf that they can never do wrong.
To consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well.
It's hard to imagine that this is really bad financial advice. No financial advisor is going to tell you to put 100% of your capital into the S&P 500 and keep cost averaging into it. And the likes of Berkshire Hathaway's billionaire Warren Buffett here, who also doesn't follow that advice by primarily in the last quarter loading up on things like oil stocks and foreign companies like Taiwan Semiconductors, only has the S&P 500's VOO making up probably less than 0.5% of his entire portfolio. And this really comes down to luck and time frame. Obviously, if World War II, the Cuban Missile Crisis went in different directions, I can't imagine that the US would be sitting where it currently is today, which has been outperforming every global market. So during your lifetime, this has been an incredible investment and is a huge proponent of my cost average strategy of about 30% of my entire portfolio. But comparing it to like during this time frame, the Shanghai Composite or even the Toronto Stock Exchange, it's almost laughable in comparison, right? But my goal with this video is to give you clerical insight so you will have the tools and the knowledge to invest to your own circumstance and what best fits your risk tolerance, because Warren Buffett, of everyone we're going to speak about today, is probably the least wrong person. However, let's listen to YouTube's own Jeremy from Financial Education, who's been tweeting a storm of stupidity lately, saying VT is the most boring thing to do with your dollars. Change my mind. Firstly, you idiot, investing shouldn't be exciting. If it is, I guarantee you're losing money, and you are, for the fact that your own viewers recognize this, with Dan saying boring maybe, but definitely the safer thing to do. Josh saying, and one of the smartest. And if you go down that tweet hole, damn, does it get pretty entertaining and funny, because read these. Like, get off Twitter, Jeremy, and stop telling people or leading people astray. And so many others have lost money with you. You don't deserve your following. You shouldn't be permitted to have your courses, and you certainly shouldn't be permitted to keep up your scams. Jeremy, stop blocking people on YouTube comments. You are ruining people's portfolios with ridiculous picks like Oatly, Planet 13, Tattooed Chef, etc. FTC needs to investigate you. Scammer alert, fraud alert. I don't think Jeremy's a scammer or a frauder. I just really think he's a bad financial or stock picker, and he's been very lucky in a booming market cycle to only get slapped so far upside the head that he realized he made critical and crucial mistakes. And what's really funny is he's probably like the moderate guy to come to that awakening, because most people have egos so big that they want you to idolize them like they're some trophy on a shelf that they can never do wrong. And Michael Burry probably being a really good factor to this, always reminding you on his Twitter that, hey, long ago, far away on set, that I was once the smartest dude on the planet and shorted the market and made billions. He'll always remind you of that, even though he hasn't been right since then, really. And now he's always going to follow those tweets up by saying inflation peaked, but it's not the last peak of this cycle. We are likely to see CPI lower, possibly negative in the second half of 2023, and the US in a recession by any definition. Fed will cut and government will stimulate, and we will have another inflation spike. It's not hard. It must be pretty hard considering you said the markets were overvalued and to short them in like 2016, 2017. Still haven't come anywhere near close to those price points, and everything you say hasn't actually materialized into outperforming the S&P 500. So I'll probably stick to Warren Buffett's advice rather than you, Michael Burry, sir. But this only gets funnier, right? Like, let's listen to Everything Money and their thoughts. It kind of follows suits with Michael Burry's.
Remember, valuations we talk about are always going to drive stocks in the long run, right, Mo?
Yeah, absolutely.
And valuations are still heavy.
They're driving stocks right now.
Yes. So if you look at valuations now, as of yesterday, we're at 60.1% overpriced going back to 1929. And that's bad. You know how bad that is? The dot-com crash is considered the most overpriced market. Here's the dot-com's peak, 57.1%. That was the peak of the dot-com overvaluation. We're at 60.1 after falling 20% in the S&P. After falling. NASDAQ's down over 30%, and we still have a long way to go.
All right, not to make this too confusing, but these morons are going to try and tell you they're value investors. They're going to buy discounted stocks to free cash flow, things like Alibaba, which he overpaid by 40% for, Meta stock, which they're losing more money than the general index has lost. And they're going to sit here and remind you that the S&P 500 is largely overvalued. That's what they're representing. And they're saying it's 60% overvalued with their charts going all the way back to the 1920s, which doesn't make any sense because the historical S&P 500 PE has been around 14 to 15. We're currently sitting at 20, which doesn't represent a 60% overvaluation, and I don't understand how it's comparable to the dot-com bubble when even through the March 2020-2021 hype period, we never actually reached valuations that were comparable to the dot-com era. In fact, the highest valuations in the market were during the crash of 2008. I personally think the markets should sustain a higher multiple because we're moving into a technological revolution, which leads to higher margins on companies. Most of the S&P top 10 companies are making higher margins than companies even saw 20 damn years ago. And I'm glad at least value investing idiots can also remind you that, hey, cost averaging the S&P 500, like Warren Buffett says, probably the way to go, not listening to these fools and giving them your money to figure out a valuation tool that doesn't, it's all Fugazi anyways, right? But here's Kevin O'Leary, a guy that's really good at understanding Fugazi because it's been his entire career over the last few years.
Binance is a massive, unregulated global monopoly now. They put FTX out of business. Now, lots of other reasons, I'm sure, but that's my personal opinion. That is what Sam Bankman-Fried told me in terms of where the assets went. Why should we care? Single reason. I'm a shareholder. You tell me the two largest shareholders do a transaction together, that's a related party transaction. I'm not sure that's okay. Maybe I want a Madoff clawback.
Kevin O'Leary, you're a complete and utter idiot here. You should be removed from CNBC moving forward. You got paid over $15 million from FTX to be a sponsorship spokesperson. Now you think you're helping the little guy out by trying to fight to get dollars back elsewhere when the dude you were working with was a complete fraud, lied about the books, didn't actually do anything to a professional level that your due diligence team couldn't figure out on their own. If anything, maybe the marketing dollars that were given to you, you should actually have to funnel out of your own pocket for pump and dumping a scheme that you clearly, again, markets are Fugazi, you don't do any research, and you've lost your way of what your mother used to taught you about cash flowing assets that could appreciate in value. The true understanding of what I'm kind of reforming back to in the reality of investing that isn't really that hard. I'm just trying to give you guys the tool set, the knowledge. This isn't going to be easy. Investing isn't exactly the funnest thing in the world, but the fact is you can't keep listening to all these people and presume you're going to be going in the right direction. They're all going to lead you astray. So because the markets are pure Fugazi, I can only do what's going to work for me, and hopefully that you can learn something that could adjust to your own circumstance. I'm 30 years old. I have 6 figures invested. I have it invested between multiple economies, multiple currencies, foreign assets, and it's all cash flowing and paying me a regular paycheck. I don't know whether it's coming or going. Do I take value investing into consideration when I'm buying stocks like Taiwan Semiconductors? Absolutely. Do I take valuations into consideration when I'm cost averaging the S&P 500? Hell no. I'm playing a multitude of games here. If you're older, maybe bonds, GIC is better route to go. I can't tell you what's going to work for you. I'm just hoping you're learning something from this channel and you're taking critical thought into your investing decisions and you're not just blindly following any investment advisor or billionaire. And if you can appreciate that, hit that like button and subscribe while you're down there.